Good morning, everyone. Welcome to the August edition of the Blackfinch 10-minute market forecast. Thanks for joining us today. My name is Josh Clayton. I'm the Assistant Portfolio Manager here at Blackfinch Asset Management, covering our managed and tailored portfolio solutions. For those of us joining for the first time, we use this webinar to cover what we believe are some of the most important events impacting global markets and ultimately your client investment returns. And we're also going to dig into how we're positioning our own portfolio so you can then be better prepared for conversations and meetings with clients over the coming weeks. If you have any questions during the session, you can submit them using the Q&A box at the bottom of your screens. Alternatively, do reach out via contact details on the final slide. So before we cover today's content, I just want to take a moment to remind everyone that the content we cover is intended for financial professionals only. It shouldn't be taken or interpreted as financial advice. And so on to the themes. And July was an interesting month because on the surface, the headlines painted a fairly challenging picture. We have renewed conflict in the Middle East, which pushed oil prices higher. Central bank rhetoric became more cautious, and equity markets experienced a notable increase in volatility, particularly across the tech sector. But if you look beneath the surface, there's a bit of a different trend that's been bubbling away. And it's one of growing corporate earnings, relatively resilient economic data, and growing capex towards AI from the major hyperscalers. So you'd naturally ask, if the fundamentals are so robust, then why have markets become so volatile in July? And that's really the answer that I want to get to the bottom of today. And again, hopefully you'll have that for your clients if they do ask over the coming weeks. So that's the core theme. Earning seasons will move to central banks, and finally, inflation and what it means for our portfolios. And before we get into the meat of why markets have been so volatile of late, I think it's important to look at company fundamentals just at the index level. And it's been really an exceptional earnings season. This chart runs to the end of July, and by that time, around half of the S&P 500 reported results. They're always the poster child when we're looking at earnings and thinking about them, and they're showing earnings growth running at around 26% year on year. And tech has led the way once again. The Nasdaq earnings growth exceeded 40%, and then emerging market tech companies have delivered the strongest growth of all. And it's the standout on this chart. I've been a bit cheesy by putting a lightning bolt on it, but emerging market earnings have exploded. It's largely come from a handful of stocks in the emerging markets tech space. Companies like Taiwan Semiconductor, Samsung, SK Hynix, all of these names are critical to the AI supply chain, and they really have been cashing in from all of the spend from these large hyperscalers in the US. And if you just take that EM bar, look to its right, you can see earnings away from tech shows, circa 10% growth. It isn't anything to turn your nose up at, of course, but it's just overshadowed by what's going on with this trend. If we were to include tech, it's 10 times that. And then it's important to highlight the companies haven't just met expectations, they've exceeded them. And that's the light blue bars on the right-hand side here. Just to explain, earnings surprise is the difference between a company's reported profit and what financial analysts expected. And naturally, it has a big impact on share price. But if we put it into perspective, these earnings surprises that we're seeing in the quarter have been above historical averages. And that's just showcasing this profitability at the moment. And then I think it's important to drill down into some of the individual companies, the mega caps, and that also paints the picture. Alphabet had a strong quarter. It was driven by accelerating demand across Google Cloud. It announced a further increase in AI capex, and please keep the AI capex in your head with these stocks. We're going to explore that. Meta did well as well, exceeded expectations, strong advertising revenues, another meaningful uplift in AI investment. And if we go into Asia, SK Hynix, they reported operating profit growth of more than fivefold year on year. So 500%, 550, I think it was. And that's just reflecting that strong demand for high bandwidth memory chips used throughout this AI ecosystem. So the common theme's clear. Companies aren't at the center, aren't pulling back from AI, they're committing more. We're seeing them invest aggressively into the tech because they do believe the opportunity is there at the other end of the spend. And despite all of that, share prices came under pressure in July. I want to explore that now. So the question is now becoming about the expectation from this spending. And this chart kind of helps explain that. It's a piece of the puzzle. So despite strong things have been volatile. Historically, when tech companies beat earnings expectations, investors are rewarded. Naturally, you think those strong results translate into positive share price performance. And broadly, if you look across history, we're going quarter on quarter here, you'll see that's the case. But this quarter specifically has been different. So after those earnings, we've seen this painful sell-off. And especially in the tech market, after some healthy returns, there's been profit taking, and by proxy, the other indices like the S&P 500 and so on have been caught up in that sell-off. And that's because the market shifted from rewarding good results to scrutinizing future returns. And let's just circle back to Alphabet as the example. The results themselves were excellent, but much of the discussion went straight to the AI capex part. And particularly how it was funded. Meta was the same. Investors are looking beyond the earnings and they're looking at this required level of capex to stay competitive. And we're starting now to see this growing level of investment is coming from debt issuance rather than purely free cash flow. And it isn't a concern itself. These are the biggest players in the world with the strongest balance sheets generally, but it does demonstrate the sheer scale of this build out that's underway. And this is why markets are scrutinizing. For the picks and shovels part of the AI trade, the hardware and so on, a lot of the emerging market companies we talked about that are providing the infrastructure, they're going to see that as a net positive on the balance sheet. But if we do see this continued narrowing of free cash flow into debt issuance from these major players, this growing expectation is going to get larger. We want that demand for a return on investment. If we don't get it, we may see more volatility going forward. So these earnings releases are becoming much more important. They always have been, but ever more so now. That talks to the big step down on the chart here. This is, sorry to explain the chart, it's just the average next day move after a company shows a beat in their earnings per share. And this is just kind of framing that expectation. On top of that, we throw in the conflict and what's happening there, almost a perfect storm for some profit taking. And I do think it's worth saying this transformational technology rarely just produces straight gains overnight and productivity benefits. Building the infrastructure is the easy part. Embedding AI into business models, improving efficiency and generating measurable returns takes years rather than quarters. Seeing this in the data is going to be hard. I've spoken to countless economists that are trying to do that. They're trying to go through the thickets to find it. It's all just too muddied by other external effects, lagging effects from things like the pandemic and so on. So for us, this just feels like a reset and expectation. It isn't a deterioration in any sense. Painful but healthy bit of profit taking off these names. So while markets stay volatile in the short term, I think the structural AI story still remains firmly intact. We do think it's broad. We do think it's economically significant. It will just take a bit of time. So away from earnings, the other part of the story was central banks. Markets spent much of the month repricing interest rate expectations following all of this tensions in the Middle East and higher energy prices. We're seeing investors ramp up questioning on whether central banks are going to need to tighten again after we, all thought it was over. After reviewing the minutes from the European Central Bank, the Bank of England, the Fed, all of the policymakers are pushing this measured approach, data dependent, incoming data. They're ready to act and to fight off inflation if needed. For the Fed specifically, they left rates alone. Inflation is, of course, still above target, but again, there was little urgency to tighten policy further because the broader economy remained pretty resilient, growth and employment. Rather than offering forward guidance and giving markets any nuggets or hints of what's going to come, they reinforce that dependent approach. And all of that speculation of the new Fed chair, Kevin Warsh, was he going to crumble under his leadership? Is he going to quickly begin cutting rates under pressure from Trump? He's quashed that, which is good to see. The chart shows this story. The blue line just shows where investors expected interest rates to go over the coming year. The red is what has actually happened, the Fed's actual policy path. Earlier in the year, markets have been pricing in lower rates as inflation was easing. Renewed conflicts triggered the higher oil price, triggered the repricing, and investors now are thinking rates are staying higher for longer. Key point is the Fed is ignoring the noise, looking at the data, isn't following the market. We'll see who's going to be right over the coming months in terms of how inflation moves. The last part is the UK. Of course, the principal macro risk remains inflation for us as well, particularly through the energy channel. Renewed conflict in the Middle East has pushed oil prices higher, it prompted markets to reassess the inflation outlook over the coming quarters. Higher energy costs directly feeds into transport, into manufacturing, household bills, and it just creates that issue of inflation staying higher for longer. Unfortunately for us in the UK as well, we're at the mercy of the oil price. We do have our own supply constraints. Bringing in the chart, the gold line looks at the Bank of England's baseline inflation forecasts. It already points to it taking longer to come to target. Black and blue gives some different scenarios if higher energy prices persist. Under those scenarios, inflation again, of course, stays higher for longer, but it could well reaccelerate to 3 or 4% based on economic forecasts. So this is the uncertainty policymakers are having to navigate. The tensions in the Middle East are keeping that oil price high. I think it's too early to know whether we are going to see a supply shock or something more persistent. We're following articles as closely as we can. A point to say as well is that oil reserves are materially lower, so we are more susceptible to a prolonged conflict if it does go out that way. But for investors, inflation is hasn't become the base case just yet, but the range of outcomes has widened. It's likely to keep interest rates higher, or the expectations quite volatile over the coming months. But it all points back to, for us, maintaining diversified portfolios, thinking about the high quality fixed income, the duration levers we can pull, listed property, and other kind of absolute return strategies all help dampen the equity volatility we're seeing and help investors stay anchored and look at these structural growth opportunities we have elsewhere. And that's really something we want to drive home here at Blackfinch. So just to summarize, a volatile July, I don't think the messaging's changed. Let's look through the short-term noise, follow the money, the underlying fundamentals, remain diversified. We're seeing strong earnings. That committed AI investment helps the picks and shovels part of our portfolio. And yeah, we need to be conscious of the volatility going forward around some of these names. So thank you for spending your morning with us. As always, if you do have questions off the back of today's content, I'd love to hear them. I'd love to engage with you. Do drop me an email or Mark, who's our head of asset management here. And as a reminder, our next webinar is the first Tuesday of every month, and that actually falls on the 1st of September, same time of 8:50. So I do hope you've enjoyed today. Have a great day and take care.